Hi, this is John Coumarianos with Mindful Advisory, bringing you a new edition of Driving Returns. What drove returns this week was the Federal Reserve meeting. The Fed Chair Powell indicated that there would be three rate cuts for the rest of the year. Hard to be certain about that, though. I think if inflation comes in again above 3%, we might not get a cut, that first cut in June, which is when most people expect it right now. We'll have to wait and see how inflation comes in, but the market took some confidence from Powell's remarks that there would be three rate cuts in the offing. Stocks, the S&P 500 was up nearly 2.3% for the week. That puts it up around 10% for the year. It's really quite a gain for 3 months. Global stocks minus the U.S. Decidedly more muted, up around 1% for the week. Bonds up 0.74% for the week. That's a very big gain for bonds in 1 week. So the volatility in the bond market continues. REITs, I thought I'd show REITs here as well. The Vanguard Real Estate Index ETF, not that REITs didn't move much at all. The fund was up 0.13% for the week. It's actually down 3.5% for the year. It's hard to know if real estate is a good contrarian play right now. If we get inflation, it's true real estate companies let's set office space to the side. Real estate companies can raise rents. The problem is they also run with a lot of borrowed money. And if their borrowing costs go up, that of course crimps profits. And I think that has investors worried, in addition to all the usual concerns about office space and retail space. So hard to know if real estate is a good contrarian play right now. It may be. Um, the second thing that ran across my radar this week was a book by a former trader named Gary Stevenson. His book is called The Trading Game, and Stevenson traded interest rate swaps in London for Citigroup at around the time of the financial crisis and a few years after that. And his book is interesting because he says the bet he thought initially was, well, surely rates are going to go up after being lowered so much. And every year that passed for a few years, they didn't go up. And he realized that lowering rates was self-defeating in a way. It didn't stimulate the economy. And so that's why, in a way, rates have stayed down. No one, the Fed hasn't gotten the message that lowering rates doesn't really stimulate the economy. Of course, rates finally did go up two years ago or so, but for a very long time they remained low, and it remains to be seen whether they'll go back lower again. But Stevenson's argument is that lowering rates just elevates asset prices. It puts money more into the hands of rich people more than it does into the hands of middle class and poor people. If interest rates are zero and you're poor or middle class, you can't really borrow very easily, and so it does you no good that interest rates are very low. And so they're not stimulative. And so I've got here a chart showing GDP year over year, GDP rolling monthly, and you can see since 1990, GDP growth has slowed down. It may be just that we're never going to get the economy we had in the post-war period up until 1990, but it may have something to do with low rates just not being stimulative. So we'll see. It looks like an interesting book. Anyway, this is John Coumarianos for Mindful Advisory and for Driving Returns signing off. If you like the work we do, please click the like and subscribe buttons. And if you have questions about asset management or financial planning, please call us at 201-951-3509 or visit us at mindfuladvisory.com. Thanks very much.